Exchange-traded funds, or ETFs, are simply baskets of securities that trade on an exchange. They are easily the most successful investment product introduced over the past 30 years. In the US, they now account for 30% of dollar volume trading, but other markets are catching up fast. Here in London, ETF volumes grew 50% last year and now account for 12% of total volume. An ETF is very much like a mutual fund or unit trust, but with a couple of important differences. First, ETFs trade continuously throughout the day, rather than being settled at the close. This is a big advantage because it allows investors to pinpoint the exact time and price at which they transact. The second difference has to do with taxes. With a mutual fund, investors have a tax liability for dividends paid by the components of the fund, as well as any capital gains incurred as the investment manager buys and sells. Those ongoing taxes then affect the investor's cost basis, which is used to determine taxes owed when the fund is finally sold. It can get very complicated. Fortunately, fund companies keep track of all that and issue the appropriate tax statements to the investor. But all that record keeping is expensive. For this reason and others, mutual funds usually have higher expense ratios than ETFs. Typical fund expenses range from 0.5% to 1%, while the most liquid ETFs charge a few hundredths of a percent. ETFs have other advantages. For example, some of the components of the ETF may be difficult or expensive to buy outside of the ETF wrapper, as for example in emerging markets. It's much easier to buy an ETF rather than the individual securities in different markets, and without having to worry about currencies or any extra fees or restrictions those markets may impose. Initially, most ETFs were passive instruments designed to mimic the returns of an index like the S&P 500. In recent years, investment managers have introduced products with broader mandates. Some of these are actively managed to try to improve on the index returns. One particular strategy which has become popular is called smart beta. The idea here is to tilt the fund toward a characteristic which is expected to outperform, such as low price to book. Of course, ESG strategies, environmental, social, and governance, are popular nowadays, and there are lots of ETFs designed to meet that demand. For all of these strategies, ETFs offer an easy and inexpensive way to invest without doing the hard work of selecting individual securities. Finally, what are the implications of the rapid rise of ETFs? In general, I think it's a good thing. ETFs have made investing easier and cheaper, to the extent that they have also made passive investing more popular, which I think they have. That's also a good thing. But I'll end with one note of caution. Most people who buy an ETF don't know what's in it and frankly don't care. But as ETFs and passive investing have come to dominate the investing landscape, they have become proxies for investing in large and expensive stocks. When individual components of an index ETF perform well, they become a larger proportion of the index, which means the ETF must buy more of them, which causes them to go up even more, and so forth. It becomes a self-reinforcing loop where the dynamics of passive investing become more important than company fundamentals as a driver of price. After a while, a relatively small number of large, expensive stocks like Apple come to dominate the market. This can create systematic risks because the same forces that cause these stocks to go up can also cause them to go down if selling starts.